All right, everyone, we'll go ahead and get this kicked off. Today we're going to be covering 401ks, specifically solo 401ks and other employer plans. We're going to touch on a few of those, but the main focus today will be on the solo 401k and its power that it has for you as a self-employed individual or operating an owner-operated business to really kind of maximize your contributions, the flexibility with regards to how you acquire and record keep assets, and all the other cool features that these plans offer for those individuals that qualify for them. Again, if you do have a question, please do type them into the chat box, and we will address those. The raise hand function does not do particularly anything on this. My name is Alex Perny. I've been here at Advantis since the beginning of 2012. I do really enjoy 401ks and the associated things that go along with them, past just what I handle with IRAs, health savings plans, Roth IRAs, and everything else. So if you do have any questions after this presentation, my contact information is right here. Please ask away. I'm always happy to assist people, whether it be scheduling a consultation or just chatting over email as well. Before we get started, I just need to make sure that we do give our required legal disclaimer that Advanta and our employees, we do not provide legal, tax, or investment advice, nor do we endorse or promote any investment products. All information materials are for educational purposes only, and all parties are encouraged to consult their attorneys, accountants, and financial advisors before entering into any type of investment. I do see a few people with their hands raised. If you do have a question, please type those into the chat box. Audio, you should be able to. One moment. A few people say that they are having audio issues. Okay, great. Yeah, sorry. If you can't hear me, I do apologize. I am confirming that the audio is coming in. So again, you do need to just refer to the plugin or the other the toll-free number, the 866 number as well. So we'll just go ahead and keep moving on. Okay, so a few key points that I want everyone to take away from today are what types of accounts are going to work best for certain types of businesses. There's different ways to administer 401k accounts specifically, and what the reason behind the certain plans are, because there is different reasoning behind why a certain plan might work better for someone else versus another person, and vice versa. So just understand that there's a lot of flexibility when it comes to choosing a retirement plan for your business. Specifically with the solo 401k, there's a lot more flexibility in those plans, but ultimately the scalability might not be as good as something that is offered by, let's say, a SEP IRA or a simple IRA for your particular interest. So just understand that there might be some reasons to choose something that is a solo 401k, or there might be reasons to choose something that's not a solo 401k. It's all going to boil down to a couple different points that we're going to get into a little bit later on in the presentation. Again, if you have any questions or you're local to either the Florida or the Georgia markets, we have an office in Atlanta, Georgia, and our corporate headquarters is here in sunny Clearwater, Florida. So if you are local and you do want to schedule a consultation, there are people in both offices that are more than happy to assist you. So what is an employer-sponsored plan? It is different from an IRA. Just because you have an IRA does not necessarily mean that you can have a retirement plan that's based for a business with those higher contribution limits. So in its most basic essence, a employer-sponsored plan, a 401k, a SEP IRA, a simple IRA, or a plan that's established for assisting employers to retain employees for the employees to be financially independent in retirement. Now, the 401ks are brought in by legislation in 1974, which is the Employee Retirement Income Security Act. So in 1975 are when we first start having these plans be established. And this is also the same time that IRAs are established as well, the traditional type IRA that everyone is so intimately familiar with. So just understand that an employer-sponsored plan has a few more parts than just an individual retirement arrangement or the IRA, and that there are some additional qualifications you need to look at before just saying, hey, I really like the attractiveness of a 401k or a SEP IRA. You do need to understand that there is a qualification for that. So the key components for an employer-sponsored plan, there has to be some type of business. Now, this business can be something as simple as a sole proprietorship. It can be something as large as a large joint venture. You can be a subchapter S. You can be a C Corp. There isn't anything that's going to inherently discriminate against you when it comes to the type of business that you operate. Although the type of plan that you do choose is going to boil down to a few very specific points. But ultimately, just understand that if someone tells you it's like, oh, hey, you have an S Corp, or you're filing as a C Corp, none of those things necessarily make too much of a difference as to your ability to establish a retirement plan, but it might drive the kind of business that you would like to or the type of retirement plan that you ultimately would like to establish. Now, you have to have participants in the plan. Now, these are the employees of the business. Now, when I say employees, I don't necessarily mean rank and file employees. For the purposes of retirement plans, typically a full-time employee is defined as someone that works over 1,000 hours in a calendar year. So January 1 to December 31, if they've worked over 1,000 hours for you, typically that qualifies them as a full-time employee. Also, if you are the owner-operator of the business, you are technically an employee of the business as well. So when I talk about participants, that can mean a lot of different things. For the purpose of the solo 401k, if you are the owner-operator of your solely owned business, or it's you and your spouse or you and your business partners, those are the employees. Those are the participants. Those are the people that are going to be covered by the plan and the considerations whom need to be given when there's contributions made to the plan, especially when we're referring to profit sharing type contributions, because in the 401k, there's going to be a few different places where you're going to pull money from, and we'll get into that in a moment. Now, the contributions are going to be where the money is coming from and if it is or able to be deducted. Now, when you add money into a retirement plan, most people are inherently familiar with the fact that it is a deductible expense to yourself, meaning that you get to reduce the amount of income that you claim in a given year by the amount of the contribution to that plan. Well, that holds true with most everything except for Roth IRAs. And the other cool part about this is that there is such thing as a Roth 401k. So understanding where the contribution's from, if there is a deduction or not a deduction being taken, is incredibly important to this, because it's ultimately going to determine the functionality and the taxability of distributions later on down the road. And just to be kind of upfront about this, when we talk about any type of non-deductible contribution, we're strictly just going to be talking about the Roth 401k in this presentation, because SEP IRAs and simple IRAs, which are the other two types of common employer plans for the self-directed market and the small business market, have no Roth component. They are all going to be deductible basis contribution plans, ultimately choosing whichever one you want. If a Roth is an incredibly important detail to you, maybe structuring or being able to qualify for the 401k would be a good benefit. Just understand that to have a dedicated Roth account and an employer-sponsored plan, it has to be a Roth. It has to be a 401k. So you do have three different plans when it comes to choosing a qualified retirement plan for your business. They're not all created equal, and you need to understand that different plans allow for different corporate deductions, and some may allow for personal deductions as well. So when it comes to where the deductions are taken, you need to kind of figure out if you are passing your taxable liability onto yourself and an S corp. Maybe you might have something that lends itself pretty easily into being a good fit for something like a SEP IRA, where if you're looking to take large deductions and pass those to yourselves personally, something like a pass flow entity might work well. Whereas if, let's say, you want to create a moderate split between taking deductions in the corporation and, let's say, a C corp, and then also taking deductions personally because you're paying out ordinary income, the 401k works well in that regard, because you do have two separate pools that you are contributing money into, one being the elective deferral of compensation, the other being the profit sharing match that is being added into that plan. So just understand that there is the big thing that I like to get into today is that you do have a lot of choice, and kind of figuring out where you would like to make these contributions can certainly can fit one of these types of plans. Now, how do you get money into one of these types of plans? Well, if you already have a solo 401k somewhere like a Fidelity or a Raymond James, and you would like to just then do a self-directed type, you can just do a transfer. You can just, as the trustee of that plan, direct the funds to be moved over to a plan administered by us. It's done as a non-taxable movement of funds, and it's, very easy to go from there. Let's say you have an existing IRA and you'd like to move it into a solo 401k or another type of retirement plan, such as SEP or a simple. You just do it as a direct rollover. You tell your current custodian to go ahead and roll those funds over to your Advanta administered account, and then you go from there. And then you can also do rollovers from other employer plans as well: 401ks, 403bs, governmental 457s, thrift savings plans, large pooled pensions like United Auto Workers or something like that. All of those kinds of things can be rolled over into a qualified retirement plan for the purposes of doing a 401k, SEP, or simple. Now, When we're referring to these types of choices, also understand, and I probably should have put it up there, what's becoming more and more common is people are referring to QRPs, or Qualified Retirement Plans. Just understand that if someone refers to a QRP in the broader sense of you doing your research, it can really typically refer to either a record-keeping plan of a larger business's 401k, meaning that you don't open up a solo 401k per se, but you open up just an account to hold cash and then report back to the trustee of, or more oftentimes a QRP will be referring to an individual 401k plan. Now, although this slide is rather sparse, I do like to spend some time on it because I want to kind of go over where your money is going to be coming from with regards to each one of these plans, because that's really kind of the biggest driving factor for determining which one's going to make the most sense for you. Now, the individual 401k is the one that we're going to spend the most time on. The simple is going to be the one that we spend the least time on. So we'll start with the simple. Essentially, it's a good plan for people that have employees that they don't think maybe are going to want to participate in a plan, but they still want to have a qualifying retirement plan to make higher contribution limits into. You can defer up to $12,500 of your income a year into that plan, and then you can either do a 2% non-elective deferral or a 3% elective deferral into that plan based on salary as well, meaning that you either give the choice or not the choice for the employee to participate in the other portion of that contribution. Again, if you have employees and you don't want to do some of the testing that's required for a larger 401k plan, simple might work. Now, the SEP IRA is what's going to be most interesting to people that are potentially looking at between an individual 401k and a SEP IRA. The reasoning behind it is that a SEP IRA is going to be great for those individuals that have high amounts of earned income. So if you're getting W-2 income from your business on an annual basis, a lot of realtors like this, people that get high income that is going to be subject to Social Security, Medicaid or Medicare and all those other kinds of taxes, the SEP works really well for them because it allows you to defer up to 25% of your income. So whatever your total salary is on a given basis, lets you defer up to 25% of that income into your SEP plan on a given basis. It also creates a corporate deduction for that and lets you reduce the amount of taxable income you claim for a given year. So just to recap that, you create a corporate deduction and then you get to reduce the amount of income that you're claiming in a given taxable year with the SEP. And that amount is 25%, not to exceed $55,000 for the taxable year that you're referring to. Individuals also still get to make their annual $5,500 or $6,500 contribution for that year as well. And keep in mind, a SEP is always going to be a traditional type account. Now, a cool thing about a SEP IRA, and I covered this in my last presentation on Roth conversions, is that some individuals will say, hey, great, maybe I'm making a lot of money and I don't necessarily get over to the individual K plan side of things, but I want to still have a Roth account. Well, there's nothing in the legislation that says that you cannot make your full $55,000 SEP contribution and then immediately convert it, pay the taxes on that. So then instead of taking that large deduction, maybe you do work in an S-type corporation where you're passing that deduction along personally. Maybe you don't. But the key is in here is that you can take your full max out SEP contribution and immediately convert it into a Roth IRA. You just claim the taxes on it, and then it is immediately in a Roth account for you to do completely tax-exempt growth investing for the remainder of the life cycle of that account. It's pretty cool. We don't see as many people utilize that structure and that strategy, but just keep in mind that it is available to you. Just because the individual 401k with its built-in SEP the individual 401k with its built-in Roth contributions may not be the best fit, the SEP IRA can certainly still be used with strategies in order to get funds into a Roth IRA as well. And if I'm going through this at any type of pace and someone has a question, feel free to fire it in there. These things are definitely the area to get questions answered for these. So please make sure that you do get your questions answered if you do have any on these. Now again, so the SEP IRA is going to be a percentage of your total income that you defer into the plan. It is a type of traditional IRA. Keep in mind that these are both IRAs, so they're individuals based on the actual business that are opening up these types of accounts. Now, the solo 401k plan. 401ks in the broader scope of the retirement planning market are one of the more common types of plans out there with regards to large corporations because it allows for a high degree of flexibility for the business when it comes to what is actually paid into that plan. And that can go both ways. It can be good for people that are looking to make high contributions to a plan in a solely owned, closely held business, and it'd be good for employers of large businesses that don't necessarily want a very expensive plan to allow participants to participate on their own schedule. And it also gives them the flexibility to make Roth or traditional. So with a 401k, you have two different parts of your contribution. You have your elective deferral of compensation, which is what you take out of your own pay every year and put into the plan. If you're under the age of 50 and a half, that number is $18,500. And if you're over the age of 50 and a half, you get an additional $6,000 bump on that. So you get $24,500 as your contribution limit for your elective deferral after the age of 50 and a half. Now, keep in mind, with this, that has to be coming out of funds that you are claiming Social Security taxes on. It has to be W-2 income. So you can't just keep everything in a corporate side, keep it cyclical on your LLC and then still make that. It has to actually be paid out. The nice thing about that, though, is unlike the SEP IRA, there is no sliding scale of saying, hey, I can just take 25% of that compensation and then put it right into the plan. You can make effectively a 100% compensation contribution of your elective deferral to an individual 401k plan, meaning that if you pay yourself $18,500, in theory, you can put that all directly into the 401k if it's paid out of the business that you're covered under. However, you do have to make sure that you have sufficient funds in order to pay the taxable liability associated with that and to make sure you're covering your minimum withholding requirements as well. So in practice, you do have to pay yourself a little bit more than the actual contribution to that plan, not by much. You would need to get with a CPA or tax professional to determine the sweet spot of how much exactly you need to pay yourself. And again, that does go, also with the bump of $6,000 to the age of 50 and one half. Now, this plan, and most people are familiar with, you can get up to or close to almost $60,000 into these plans a year. So where does the other portion come from? The other portion comes from what's called a profit sharing or a corporate contribution into the plan. Now, a lot of people will think of this as my employer's matching a certain percentage of my total pay. There's a few different ways that you can actually structure this, and that's a very common way is for an employer to say, you know what, I will match up to 5% of your total compensation on a given year, which makes the plan a little bit cheaper to administer for them because they are locked into that to treat all employees equally. Now, with a solo 401k, if you really want to be aggressive with this, the max out numbers for this is you can contribute up to 20% of your net operating income in a given year, not to exceed $35,000. So you have the $18,000 or $18,500 or the $24,500 that you can contribute out of your own pay, which is personally deductible. And you also have the corporate addition of funds, which is the net operating income contribution, which can be up to $35,000 per year. Now, keep in mind if you are the only individual participating in this plan, meaning that it is just you as John or Jane Smith operating as a sole proprietor or a single member LLC, that all to you. But if it is a husband and wife or a spousal plan, meaning that you as married individuals are the two covered under the plan, you have to divide that amongst all of the participants of the plan. So if you only made, let's say, or have $40,000 of net operating income on a given year, you can't put that full $35,000 into the plan as a profit sharing match. So just keep that in mind. That is going to be divided amongst all the participants of that plan. So just to recap on the 401k. You have an elective deferral of compensation, which is W-2 income, which is either $18,500 or $24,500, depending on your age. 50 and a half is that tipping point. And then you also have the profit sharing match into that plan as well. And the cool part about these plans is that you have the ability to kind of do a few different things when it comes to Roth with them, meaning that you are not going to take a deduction for any of this. You are going to make this stuff grow and then eventually be distributed tax exempt. So, and I mentioned that there are two ways to do this. One, you can just elect to not take a deduction for your deferral of compensation, so that $18,000 or $24,000 that you're putting in there. You have, as the participant of this plan, the election to say, hey, I don't want to take a deduction. Then that becomes Roth. Just like a Roth IRA, you don't get a deduction for your $5,500, but all of your earnings grow tax exempt and then are distributed tax-free in retirement as well. The same aging limitations required for a solo 401k Roth are still going to be applied, or are applied just as they are in a Roth IRA, meaning that you have to be 59 and a half, and the plan has to be an establishment for at least 5 years in order to enjoy those fully tax-free distributions. Now, that means that you have another portion of this plan that's inherently not Roth. Well, the nice thing about being a solo 401k and being the plan owner and the trustee of the plan is that you essentially get to make all the rules within the legislative bounds to this plan. So you can allow, as the trustee of that plan, to do a Roth conversion of the safe harbor contributions, which are the contributions made by the employer to that plan. So you can effectively take that entire plan and make it a Roth 401k by still keeping the entirety of that balance within the plan, converting it in plan, and then getting close to $60,000 a year of Roth contributions into a solo 401k plan on a given year. Now, that is a perfect scenario assumption, meaning that you have to have high enough earned income that you're being paid out to make your full contribution of $18,000 or $24,500. You also have to make the assumption that your net operating income is going to be great enough to allow for a max out contribution of $35,000 per participant. But again, you don't have to max everything out in order to do a Roth conversion. Just it's a nice attractive number when you tell someone that you can do almost $60,000 of Roth contributions in a given year completely legally. It's just a matter of making sure you figure out, what that number is, and you don't have to do entirety of the plan as a Roth conversion. You can do a small portion. You can even split it to where you're taking your corporate deductions for the net operating income contribution to the plan as a deductible expense to the plan, and then you are taking non-deductible contributions and putting it in there. You can administer this all together. You don't necessarily have to carve it out. You have a lot of flexibility with these plans. So just understand that, you as the trustee, you get to make a lot of determinations of how these funds are accounted for, if you will, and then you also get to make all the decisions with regards to how the investments are made. Okay, just like to put this up here. It's always kind of good, especially when people go back to review this on YouTube, that or for those individuals, if you want to snap a screenshot, just all the contribution limits for this given year. Some good news, everyone, is that we are getting a $500 bump. I know it's not a ton, but it is something for traditional and Roth IRAs next year. So for individuals under the age of 50 and a half, it will be $6,000, and those over 50 and a half will be $7,000. Okay, we have a question. Okay, you mentioned that a $35K max out employer contribution to a single 401K, 25% of compensation up to $55,000 based on $275K of compensation. So what you're referring to is you're dead on with regards to a SEP plan. So the 25% of compensation up to $55K is the SEP contribution. So that is absolutely right, based on 275K of max out contribution. And remember, that is going to be a corporate deduction and a personal reduction of income paid out to yourself. Yeah, Steve, you're right on this, but that's just referring to the SEP. Okay, with regard to investment options, they are as varied as the day is long. Now, the cool thing about when you do a solo 401k and you elect to self-direct it is that you as the trustee are the one that really ultimately gets to determine what's the best fit for that plan. And if you have a few people participating, obviously those plans can grow pretty quickly, because remember, you're talking about individual contributions into those plans on a given basis. If you have the ability to max out 2 people in a solo 401k, let's say it's a spousal couple, you have the ability to get almost $120,000 per year into that plan for going out and investing. Again, that's assuming perfect scenarios and high enough revenue streams in order to quantify those contributions, but it starts to get into the realm of a lot more possibility than just starting an IRA from the beginning to get into things like real estate, to get into things like secured real estate lending. So just understand that the other kind of power of this is it's not just you looking at the solo 401k as an individual account. If it's you and 3 business partners, because the solo 401k can cover without the restrictions of something, so we'll get into in a minute, any business that is owner-operated or spousally operated, meaning that it's a single-member LLC or a solely owned business by one spouse, both can be treated as participants of that plan. So that's just one thing I'd like to make sure people understand is that the realm of possibility for starting from a baseline and then working into things that are big attractants to people in the self-directed market is a lot quicker with these types of plans. And then in a moment when we get into being able to borrow money and debt finance within these kind of plans, you don't even have to be remotely near those max out numbers to make these things very attractive as well. So just to kind of enumerate on there in case people are only listening, the investment options that you have out there that we primarily see are things like real estate, secured lending on real estate, private LLCs, although in some cases with a 401k that may not also be necessary, futures and forex trading, private placements, things like pre-IPO companies or people that need capital investments in their company to get something done, purchasing capital equipment, oil and gas rights, tax certificates, structured settlements, the list goes on and on. So the amount of things that you can invest in is even more varied than just what we as maybe an administrator of an IRA would allow, because you as the trustee of these plans are the ones that are going to really be able to make the rules and set the boundaries of what you want to actually participate in with the funds that are held in that plan. Now, just like with IRAs, there are a few limitations when it comes to what you can and can't purchase and whom you can and can't deal with. So with the 401k, you still cannot buy anything. You cannot buy anything that's basing its value on collectability. Things like antiques, rare bottles of wine, artwork, stamp, coins, things of that nature. Things that are inherently subjective or that don't have any other value than being personally utilized. You also cannot purchase a life insurance policy in a qualified retirement plan. There are different insurance products that are sold by life insurance companies and different ways that some people get involved in life insurance products, but term universal life insurance products cannot be held as the primary investment of a 401k, a SEP IRA, or a simple IRA for that matter. Now, there also are people that you cannot directly deal with a 401k or other type of retirement plan. These are called disqualified persons. So essentially they are going to be the lineal descendants or ascendants of yourself personally, meaning that you cannot directly buy or sell anything to your mother, father, son, daughter, or spouse. You can partner with these people, you just can't directly deal with them. Now, with regards to siblings, you can buy and sell to them or directly transact with them to your discretion. I would always highly recommend that if you're going to deal with anyone that is a familial relation to you, that you make sure you are always doing it on a fair market value basis, meaning that if the house is worth $100,000, do not sell it to your brother or sister for 20. Or if they are selling you something, do not buy it for less than what the market value would dictate. Ultimately, it's going to be your discretion as the trustee of that plan to make sure that things are being done in good faith and in compliance with IRS and Department of Labor rules. So just keep that in mind as well. So scalability, and we're going to spend a few moments on this because one of the big determining factors as to which type of plan is going to work is going to be how many employees your business has. Now, keep in mind when we talk about employees of a business, just because you're a sole proprietor does not mean you have 0 employees. You are the employee of your business. Just because your business solely employs you, who is the owner and operator of the business, does not mean that, for the purposes of this presentation, you are not qualified as an employee. But when I say employees past just you as the owner-operator, you have to understand that there are some additional requirements that you have to look at with regards to retirement plans. So with a solo 401k, you do not have any type of testing or accounting that has to be done to make sure that all of your employees are being treated equal. However, if you do have a rank and file employee, meaning someone that works for you more than 1,000 hours per year, then you do have to make sure that they are offered the plan if you have one. Now, this gets into the realm of having a lot more compliance be done with these kinds of plans. So if you're someone that owns a business, even a small business that you think a 401k might be good for, but let's say you employ a bookkeeper, someone that comes in 3 days a week, works the books, does your accounting, that person probably qualifies to be covered under that plan if you establish one. In that case, you're going to have to understand that your administrative costs for a 401k are going to scale, and they're going to scale rather quickly because you're going to have what's called employee discrimination testing done. You're going to have plan testing done to make sure that the contributions and the participation are being equally offered to all eligible participants for that plan. And you're going to get to your plan asset limit of needing to have to do what's called Form 5500 reporting a lot quicker. So just understand that the solo 401k, inherent in its name, solo, meaning for solely businesses or businesses that are only owned by that are owner operated, are the ones that are exempted from all the compliance or are exempted from the discrimination testing that larger 401k plans have to do. So with that said, we certainly have people that we can refer out to. We strictly do the plan administration for solo 401ks here at Advanta, but we do have people that can handle larger 401ks as well. So don't let that be a deterrent to you just because you maybe have some people that are employees of your company, but just understand that you might have to offer it to them as well. Getting a little bit further down into some complexities, and I won't go too far into it because it's a presentation in and of itself. If you own more than one business, own more than 50% of more than one business, you are deemed to be what's called a controlled group. So if you have one business that has, let's say, 10 employees and another business that is just your own ownership, and you own both of them 100% or 50% of both, you might have to offer the plan to that other business as well. So it's one of those things where in the 45 minutes to an hour that I have you here today, it's always good to jot down some questions and then give me a call so we can kind of get into the fine minutia of what might actually be going on with yourself, the businesses that you own, and where you may or may not have to actually offer that plan to. So just keep in mind that the 401k, as attractive as it is for the solo crowd of, you don't have any employees, you don't, the businesses, can be incredibly powerful. The complexity of those plans can start to ramp up, and we do need to take a look at some stuff because, there certainly are some additional considerations for those. The SEP and the simple IRA, while they don't necessarily have the power of the 401k, are a little bit cheaper to scale. A SEP IRA is, there's zero discrimination testing that has to be done on it. You have to acknowledge when you establish the plan that you're going to offer it to everyone that is eligible. So people working 3 out of the past 5 years that are working full time, meaning that they're working over 1,000 hours a year, you got to offer it to those people. In simple IRAs, you can cover up to 100 employees. After that, you need to go with a SEP or a 401k. So the SEP and the simple are certainly cheaper to administer, but maybe aren't as powerful as the 401k. But I always do like to make sure that the 401k is the one that we spend the most time on because there's the most cool features about it. There's the coolest stuff you can do with these things is definitely with the 401k, not to say that well, I guess most people would probably consider retirement plan choices and administration rather dry topics, but I find them very interesting as to the options that are available to people and the ability of these plans to be incredibly flexible. So just understand the scalability of these plans is definitely going to be determined by which one you have, how many employees you have, and whether or not you own other businesses. And with that, give me a call. Happy to kind of go through it with you and really dig deep into the small details of those plans. And again, consultations are free. We'll get you to where you need to go. And I do definitely find this stuff very interesting. So with regard to how you administer these plans, there's some really cool stuff that goes into the solo 401k specifically. Some people like to refer to checkbook control IRAs or checkbook control accounts. Now, in order to do that with a SEP or a simple, you have to establish another LLC or a trust that account would own, that then in turn you would have the ability to write checks out of. Because they are not trustee-driven plans, SEP IRAs and simple IRAs are custodial-driven accounts, meaning that you have to have a third-party administrator custodian administering the assets that are going to be the ones record-keeping everything, and you're not going to be able to be the trustee of that type of plan because there is no inherent trustee when it comes to that type of plan administration. You do get the high contribution limits, but you do have to kind of do a little bit more structuring if you want to have that checkbook control access. The cool thing about a 401k is that you have options. One of the biggest things that here at Advanta we like to make sure people understand are the kind of options you have and what they mean for you as the account holder. So with a 401k, a solo 401k, some people will refer to them as DIY, DYO, do it yourself, or do your own accounts, meaning that instead of having Advanta in this case do all of the cash account record keeping, do the asset record keeping, you elect as the trustee to do it yourself. Now, that's great for people that are good with bookkeeping, good with accounting, making sure that they record keep and segregate all of their assets and are okay with that kind of responsibility. In either regard, you are going to be the one signing all of the transactional documents, whether or not you have someone like Advanta record keeping and doing the cash account maintenance and asset maintenance for you, or whether or not you are doing a do-it-your-own structure with that. So that's kind of cool that you don't even necessarily have to establish another entity or add another layer of the onion, if you will, if you'd like to have that checkbook control access. You can, as the trustee, open up a record-keeping trust account at a local bank. I recommend people that specialize in doing trust banking with that kind of thing. And the only thing that you are going to be in the relationship with Advanta is that we will be providing the plan documents for that 401k plan. So essentially the binder packet of things that establishes the plan, your adoption agreement, and acting as a resource, if you have questions on the technical aspects of your plan. But in the do-it-yourself method, you are going to be the trustee, you're record keeping everything, you're opening that local bank account, and really taking the reins and doing it all yourself. Again, in both cases, the trustee is the one that signs all the documents, and all of the income directed from any investments that either a do-it-yourself plan or a third-party administered plan does is going to be tax exempt. Now, that when I say tax exempt, I mean that in either regard of whether it is a Roth or traditional 401k, everything that is realized as investment income from that is not going to be taxable at the time that you receive it. So the only thing that you need to consider is whether or not you're making Roth or traditional contributions is just on the distribution side of things. So keep in mind that everything coming back is non-taxable. Now, if you want to start in one direction and then move back in the other, meaning let's say you start with us administering the cash and doing the record keeping for the assets of the plan, and you'd like to have a little bit more control, you'd like the functionality that it offers, you can switch your plan over to a do-your-own model. Conversely, if you start doing a do-your-own model and you'd like to move to an administrator-driven model, we can certainly help you with that as well. So just because you start one direction doesn't mean you can't pivot because of market trends or because of your own personal preference into another model that works better for you. So just understand that the big thing to take away from all self-directed and solo type accounts is that there is a high degree of flexibility. Now, one of the coolest things that I think exists with a solo 401k account and 401ks for almost any type of employee level is the fact that you can borrow money in them for the purchase of real estate and not pay any taxes. Now, to kind of give you a little bit of backlog on what that means is that if an IRA wants to buy a piece of real estate and does not have enough to buy it cash or cannot put together a partnership where it works cash, you can borrow money within an IRA. It has to be what's called a non-recourse loan, meaning that in the event of default, the lender agrees to only foreclose on the property. You as the IRA holder are not giving any type of personal guarantee. There is no credit being extended. The IRA is the one borrowing the money, and if there is any defaults on that, the only thing the lender can do is come after the property. Well, that still same type of non-recourse requirement is required for a 401k. However, with the IRA is subject to a tax. That tax is called unrelated debt finance income tax. It is a tax associated with the income derived from the leverage associated with the property. In easy math terms, if you were to buy a house, 50% leveraged, $200,000 house in an IRA, and it were to net, or were to get a $2,000 a month rent check, and it's 50-50 leveraged, $1,000 of that would be subject to unrelated debt finance income tax, which is tax along trust rate, so it's about 37 to 39%, I believe. I think it just changed this year. So at the end of the day, your IRA would be taking away about $1,600 from that plan, from that arrangement. Now, the amount of tax you owe as the loan is paid off progressively gets lower until you own the property outright in the IRA and the debt finance income tax goes away. The really cool thing about solo or about 401ks is that they are not subject to UDFIT tax when acquiring new real property. Still has to be non-recourse. You know, they're not as easy of a loan to find, but that is the really cool power of this, is that you can take a Roth 401k or a traditional 401k, you can go out with, you know, not enough money to buy the property outright, but put down payments on, debt finance the purchases, turn around and flip them, pay no capital gains, pay no ordinary income on what's coming in, pay no UDFI tax on the leveraged amount of the property, and just do that as much as you'd like to in one of these plans without being subject to any of those kind of leveling the playing field taxes. That is really where I see a lot of people kind of see their eyes light up when they look at this and they go, wow, that is a hugely powerful tool. And it is. You know, just understand that it has to be non-recourse. You cannot be offering a personal guarantee. You know, the leverage there is certainly the ability to do that type of leveraging is very, very powerful. Now, if you do have a SEP or a simple IRA, you can still finance within them, but you're going to have to do an additional tax filing on 990T, and you're going to have to make sure that you have an accountant that can handle that. So with 401k accounts, for the acquisition of new property, there is no UDFI liability. However, there are certain circumstances and very niche circumstances where you might have a taxable liability, but again, that's like maybe 2% of the total investable market on these types of accounts. So that's the really big thing I like to say, is that, you know, understand that the type of account you're going to choose is really going to mainly be determined by the type of business that you have, whether or not you have employees. You can certainly do some structuring to make sure that you're getting into a plan that is going to be a good fit for what you're trying to do. A lot of people do like to try to modify their employment status or how they're paying themselves out, or their corporate status, to make the 401k work. And for a lot of reasons. One, you have the ability to create personal and corporate deductions, or only create corporate or only create personal and then do Roth strategies a lot better than you could with maybe a SEP IRA, where you have to pretty much just do corporate deduction and then, you know, personal taxable liability. So depending on what you're actually trying to accomplish, the 401k offers an extremely high degree of flexibility with that. However, a big important thing to understand coming up, especially at the end of the year, is that you do have some very big looming deadlines. And that's why I do this presentation close to the end of the year, is that if you want to get a 401k plan established, you have to adopt the plan by December 31, meaning that I have to have documents signed, dated December 31. If you drop it in the mail to me and it's postmarked by the 31st, that's fine. But you do have to adopt a 401k plan in this given year in order to make a contribution for this year. It doesn't mean you have to put in money by the end of the year. You have until the 16th of October next year, if you file for an extension, to make a previous year contribution. But for the 401k specifically, and simple IRAs, you have to have them established in this taxable year in order to make a previous year contribution. The only one that gives you the flexibility to establish the plan in the following year and make a previous year contribution is the SEP IRA, which you have until the 16th of October to make that, to establish that account and make that previous year contribution. But understand that you know, this really is the time to give me a call to figure out what's going to work. And if you'd like to get the account established, at least get it established. Again, you do not have to fund the 401k before the end of the year. You have to at least just sign and adopt the plan. Also keep in mind that I always schedule at least 45 minutes to go through the adoption agreement to open a 401k. It is a significantly bigger packet of paperwork that you need to go through and some other questions that we need to answer. So it's not as simple as just kind of taking something home and going through it yourself. There's a lot of stuff that you aren't going to be able to answer on your own. And also I help you apply for the tax ID number for the plan and get everything set up correctly so that you have the ability to either do your own or do an administrator-driven model, and also get all those things taken care of for you. And just the other deadline up there, traditional and Roth IRA previous year contributions have to be done by April 15th. It does fall on the actual 15th year, so or next year, and you can establish those plans next year. There isn't any inherent big need unless you want to get something invested in to open up that before the end of the year. But you absolutely do have to have the simple IRAs and the 401ks established by the 31st in order to make any contribution for this taxable year. You don't have to make it this year, just have to have it open by that date. And with that said, that is my presentation for you today. If there are any questions, I am more than happy to answer them. I do appreciate every single one of you being on our webinar today. I believe this is the last one that we will be doing until after the new year. On January 3rd, we will have Rod Cleef on doing multifamily investing strategies through qualified plans, also a little bit of a teaser to his class in the Tampa Bay area as well. If you're not familiar with Rod, he is an extremely energetic person to hear speak, and if you'd like to, just go to advantageira.com. The event should be live today, and you can register for that as well. It is a free webinar to attend. So if there are any questions, please type them in. Happy to answer them. Other than that, thank you very much, everyone. I hope you have a wonderful holiday season and a happy new year. Steve, yes, the plan that we have does allow for participant loans. So I don't think I really covered it in the presentation, but 401ks, you can borrow money personally from the plan. You can borrow up to 50% of the plan balance, not to exceed $50,000, and that has to be paid back at least quarterly, with the interest rate being a point above or below prime. You can drag that out over 30 years if it is for the purchase of your primary residence. The length of time that it can, again, be for a non-primary resident purchase is 5 years. And it has to be quarterly payments too. And you can either, as the trustee, you can elect whether that is going to be interest only, whether it's going to be amortizing, but you do have to at least have that paid back and do it. You can do another one right after that if you'd like, but we do allow for participant loans. The interest rate would be fixed at the time of a loan. You could certainly do a amendment of that loan if you'd like to, but it's not going to inherently be variable. So you can modify the note if prime goes up or down and you want to peg it against that. You can certainly do that. Obviously, the benefit of doing a low interest rate is a lower payment, but also keep in mind that interest is going to go back into your retirement plan. So if prime does go up and you would like to peg it against a higher prime rate at a future date, you can certainly do that. You just have to do a modification of that note as the trustee. You as the trustee have to sign off on it, and the participant, which can be one and the same with you, has to also sign off on that modification of that note. But you can certainly do that if you so desire. All right. Well, it doesn't look like anyone else is firing any questions back in there. Again, if you have any questions, you don't have time to get them in today, give me a call. Shoot me an email. I am always happy to take those and get people's questions answered. Consultations are always free, and happy to try to make sure that we get you into something that works the best. Again, remember, you do have to get these plans adopted by December 31st. So if you want to, please make sure you do schedule a consultation with that, and we will get you all squared up for next year. Again, thank you everyone for attending. Have a wonderful holiday season, and we will see you next time. Thanks.